The once hot technology sector has been one of the hardest hit in the stock market rout. As we told you earlier, the tech-heavy NASDAQ is in correction territory and today posted its largest daily percentage drop in 4 years. And when the group makes big moves like that, investors pay attention because it has the biggest weighting in the S&P 500. Josh Lipton tells us why tech is tanking and what might happen next.
Tech is taking a beating. Some 40% of tech stocks in the S&P 500 are now in a bear market, meaning a drop of 20% or more from a recent high.
The tech sector has the greatest international exposure of all of the sectors within the S&P 500. And since this decline really started from concerns overseas, it's not surprising that tech is lower than the overall market.
Apple, for example, has been hit hard. The stock is now down about 20% from its recent high. Investors, concerned about slowing growth in China, bailed on Apple because the company generates 25% of its sales from there. Apple's CEO Tim Cook, though, tells CNBC's Jim Cramer that business in China remains strong. Then there are tech names like Netflix. These are crowded momentum stocks that have soared. When those kinds of go-go stocks slip, they tend to fall very hard very quickly. Still, even after a hard sell-off, Netflix is up more than 100% so far this year. Despite the rout, some investment strategists believe the tech sector will ultimately perform as well as the overall market over the next 12 months. In part, that's because they expect earnings to grow at about the same rate as the S&P. Before piling into tech, however, analysts also remind investors of the risks, including the sector's heavy international exposure. They also note that valuations, while reasonable, aren't necessarily compelling. For Nightly Business Report, I'm Josh Lipton in San Francisco.